to the Rebel Capitalist Show educational series. This is part 3. We've got my good buddy Patrick Ceresna from Big Picture Trading and Macrovoices back to explain some of the misconceptions with options and how you can use options to trade this incredible market volatility that we've had around the cerveza sickness. Patrick, thanks for being back.
Well, thank you for having me back, George. It's a lot of fun doing these episodes, and I look forward to showing some exciting stuff to all your listeners today.
Yeah, I'm super stoked to dive right in.
Well, let's do this. All right, so listen, what I wanted to do, because we're going to focus, and me and you have been talking about maybe even putting together a little course for all of your listeners, and we'll announce something maybe next week because we still have to figure out what the details will be.
Oh, no, I announced it last week. Sorry.
Yeah? Well, there
well,
you go.
Yeah, I told him we were talking back and forth, and so I had them email Sebastian if they were interested. So we've had just a flood of emails.
Oh, that's awesome. That's awesome. Well, listen, I'm looking forward to actually doing that program with all your listeners. But what I wanted to do in the next 2 sessions that are going to be these complementary ones, I wanted to really hit the myths and misconceptions and then really show some examples, because we've been doing some live trades with these options in the markets during this crash. And we're going to show real time some of the different outcomes of using this and really kind of try to help people overcome this the kind of stigmas that come with trading options. So let's just dive right into it. So so our focus on this whole thing is to really understand these options and overcome a lot of the objections people have to using them. And so what I always like to explain is options given a really amazing alternative to the typical approach to portfolio management. Typical portfolio management does one important thing. The primary tool of risk management is diversification.
Right.
And to me, a diversification is a real irritation. Why? Because it actually dilutes any chance of you making any real money. To me, if you have a high conviction on something, let's say you have a high conviction on gold, well, why can't you go all in on your gold idea? Well, you can, but what are you going to do when you're wrong? Some people like to use stop losses and do other things. But to me, options are this amazing management tool for risk. And I'm going to talk about that and how you can use it as an alternative to having to use traditional portfolio management approaches, right? Mm-hmm. And so we want to talk about the fact that these options are so widely misunderstood. And I want to really cover the 3 major uses of options. One, we can use it to generate consistent income without needing to be right about the stock direction. You know, that person that is harvesting the income or the premium in those examples we did last week. The second thing we're going to talk about and we're going to demonstrate is the idea of using the options as protection for stocks we already own. So rather than looking at this as a speculative tool, we're actually using it as a hedging tool. Right? As a way of actually managing risk. And we're gonna dive into this at the end of this presentation. And stay tuned, everyone, because we're going to show some real live trades in the live markets that are taking advantage of using options as protection. Of course, the third one is to utilize it to attain leverage. And that's where the stereotype comes in, because there's always that story of that person that loads up on a bunch of short-dated call options and they all expire worthless and they lose all this big chunk of money, and then they go, "Ooh, options are risky." Well, no, actually you were risky, not the options, right? It's
it's like a gun owner. Yeah,
exactly. Yes, options can be, if you're not well educated, can be used incorrectly and create unnecessary risk that the investor might not have been aware of. But this is where a little bit of education can really quickly straighten someone up and bring him right in line. And so a lot of these myths and misconceptions are due to a lack of understanding, and our goal here is to really clarify a lot of these. The proactive investor who takes the time and action to learn about these is, or at least does not learn about them, is discouraged and misinformed. What I love is any investment advisor that doesn't use options, will automatically by default tell someone options are risky, just so that they don't have to do the options for them or have the client leave them to go to another broker that does do options, right? So think about it. There's like something like 90% of advisors and mutual fund salesmen don't have an options license. And so what are they going to tell you? They're going to tell you the options are risky because they don't want to lose your business, right? And so let's talk about some of these myths. First of all, options add more risk. And so what's the reality is that there are risks associated with using options, but this is true for all financial instruments, right? Whether you look at what's been happening with some of these ETFs and double, triple leveraged ETFs, all these different types of products that are out there, there's all sorts of risks. The question is, can you understand your risk? See, what I like is that sometimes or what I'll kind of elaborate on is sometimes a risk, let's say in a double or triple leveraged ETF, is not transparent. You don't actually know what's happening in the background that is actually creating the risk. But when I open an option, I know exactly what my risk is. I can usually define it very well in the majority of option strategies. And it's so important to be able to recognize there's risk in everything. And that's where we were talking about there are traders out there that are successfully using options as protection and income, which are actually ways of reducing volatility and creating more consistency in returns than they are about increasing risk. And so it's all about how you use the option in the end. And so each trade, of course, has a different unique risk-reward profile, and you don't want to stereotype all of it as one. You have to look at each strategy individually. And so this is where I want to talk about this concept of zero-sum game. Obviously, last week, it made it very clear, well, there's a buyer of an option and a seller of an option. And by there being a buyer and a seller, one person's going to lose and the other person's going to win. Right? Yeah, I mean, that was almost a very easy thing to pick up on. And then it was like, well, that means somebody's going to take advantage of me when I don't know what I'm doing. But what's interesting is that it doesn't necessarily mean there's a winner or a loser. So for instance, if I owned 100 shares of Apple and I sold a covered call on it, giving the call buyer the right to buy the shares away from me at a higher price, and I receive $500 income on that. If Apple blasts it off higher, the person who bought the call is going to call the stock away and make all that profit. But you, as a covered call writer, made $500 income plus you had a little bit of upside before the strike price was hit. So actually, both parties won. One from a betting on a bigger upside. The other one got a guaranteed income. It's that old adage of bird in hand versus two in the bush. The covered call writer said, I'd rather take 500 for certain today now than the chance I could have made more, by a chance I might not make anything. Right. And so the point being is that while it's perceived it's a zero-sum game, you can't immediately assume that there's one loser for every one winner. There are lots of scenarios where both parties win. Another example is, let's say the dealer, the market maker, is on the other side of the deal. Now, they turned around and received a premium while you bought the option, but they are actually delta hedging into the markets. And that's where you hear us on Macrovoices talking about all the gamma exposures and all these different things. These dealers are in there hedging the market. So they've removed a lot of the equity risk and they are benefiting from the time decay while you're benefiting from being directionally right. Can you say that one person won or lost? You can't. And so this idea that it's a zero-sum game is not correct. Because the market is so complex and dynamic, there could be a win-win scenario in a lot of these different options trade.
I mean, I just think of car insurance.
Yeah.
Is that a zero-sum game? I mean, not really, because you're getting the benefit of being able to sleep well at night knowing your car is insured if you get in an accident, and they're getting the premium. It's a win-win.
Exactly. And so this is where I want to talk about some of the common objections to options. And so one common objection is that options are too expensive. Mm-hmm. And so when you hear this, it's like, well, I'm not going to buy it. That option's way too highly priced. But options are actually based upon volatility, which is based upon the probabilities of where the stock is likely to be. And so that option and the marketplace is through price discovery is going through the process of discovering or right pricing the option for all known information.
Right.
And so what you want to think is that you as a retail investor can just as easily be a buyer of the option as you can be a seller. So if the option is too expensive, then you're implying that you should be the seller of the option because somehow it's free money.
Mm-hmm.
And
Right.
and that's not the case. In the end, the options market is very efficiently trying to right price the option for the actual volatility of the marketplace.
Mm-hmm.
Right. So and so again, retail investors can be buyers and sellers, and then you get that price discovery happening. The second objection that I often hear is that market makers are manipulating the market. And in fact, I like to push back on that because market makers are incredibly important. They actually provide a live two-sided quote continuously on every single strike all the time, even during a market crash like we're seeing at the time of recording. And it's a very difficult job. But imagine us, would we trade options if we didn't know there would be an active market to buy or sell into when I wanted to close it?
Right. No, you
Right?
want as much liquidity as possible.
Exactly. And so what you want to think is market makers are undertaking a difficult job. I always like to kind of compare them a lot to a Vegas sports bookie, when in a sense that they're providing a bid and ask, and the spread or in the betting often is being adjusted for the flow of bets that are coming in on a particular sports game. The same kind of process. It's far more dynamic in the markets, but it's a way of thinking about it is that the market maker is just providing that liquidity for you to come in there and participate in the market. So the next objection that is I often hear is, or at least I want to push back on this market maker still has some more points here, is that remember, you as an investor, you are completely in control of the investment objectives, your directional biases, the strategy that you will use to participate, the risk management, the capital allocation, the payoff profile that you're going to put on the trade. Market makers are just there to facilitate the liquidity. Often, all of the mistakes are in implementation, not in the fact that the market maker is giving you a wrong pricing. So this is another interesting point that often is made, is that a lot of people make the objection that most options expire worthless. There's these statistics out there, and we'll talk about these statistics in just a moment. But it's this idea that it's proof that there's no benefit in trading options because that statistic says that the majority expire. This is the reason why I push back on this is that each option at different strike prices has a different probability. So for instance, if let's say right now Apple's trading at $250, it's just somewhere around there right now. If I said I wanted to buy a call option on Apple at $280, right? Well, that might actually, that's $30 higher than where the stock is trading, right? The stock's at 250 and I'm buying a call option that says I have the right to buy it in at 280. That option right off the bat might be priced at a 70% chance of expiring and 30% chance of being in the money. Why? Because it needs to rally $30 before you actually get in the money, right? And what happens is that every option and every strike price actually has a different probability associated. The one thing that is though common in the marketplace is many covered call writers and option sellers, even buyers, tend to always go out of the money on their calls. And put sellers and put buyers that buy insurance always want to put a deductible down, and therefore they're always buying out of the money puts. And so what you have is a scenario where just by this, the selection of the strike prices based upon the probability distribution, most options are initially opened with a greater probability of actually expiring. And so it really, what it comes down to is if you bought an exactly at the money option, you pretty much have a 50-50 probability of it having an intrinsic value at its expiration. Obviously, there's trend things to put in play, but this idea that the most options expire worthless is the options that do expire worthless are the ones that were more aggressively purchased. So I'll give you an example. If you on your car insurance put $1,000 deductible to lower the cost of your insurance policy, something commonly done, right? If you did that, what the insurance company knows is that if you had, let's say, a broken windshield or some other damage that is, let's say, near $1,000 or even slightly above $1,000, they're not going to be out of pocket to pay for it because of the deductible. And for that, they're going to give you a lower rate. In the same way, if I was buying insurance on the downside risk of the stock market, if I said I'm willing to take the first 5 or 10% downside risk of the stock market, then the insurance premium will be cheaper, but it has a much greater probability of expiring worthless.
Right, right. Yeah, and also too, why are you buying the option? I mean, if you're buying it just to hedge and it expires worthless, well, great, it still served its purpose.
Exactly. And so the stereotype that says, oh, the stats coming from the exchanges says that the majority of options expire worthless. Well, yeah, but that's a function of the selection of the strike prices based upon the participants of the strategy that they're trying to achieve. It's not about that everyone that buys an option is doing so simply to make money from the appreciation of the stock, and because they all expired is a bad thing.
Yeah, also
right?
Too, and you can correct me if I'm wrong, but I would assume that the options that were hit that didn't expire worthless there was huge asymmetry there.
Absolutely.
So it's not like you know what I mean? If you've got let's say 90% of them that expire quote unquote worthless, but the 10% that hit, you're making so much that it probably doesn't make up for the 90%, but it's darn close in the sense that it's, I think you know what I'm trying to say there.
Oh,
I don't know if there's
absolutely.
a professional way to say it.
No, listen, you're absolutely right though, because what it really comes down to is the fact that you have to step back and realize that it's not as simple as just this is the problem is that people just take a data point and they just spew the data point without putting context into it and understanding what is really behind it. Okay, so let's move on because I want to get to some real examples in the market.
Yeah, for
and
sure.
So here's the stats. So this is what they say is that 10% of options are actually exercised during the expiration cycle, which is about 10% of the options that are open in the market tend to be actually exercised and the physical shares exchanged. In other words, if I said I'm buying a call option for the right to buy Apple at 250 and it rallies, about 10% of people that have those options will then ultimately choose to say I'm exercising my right to buy the shares, and the physical shares are transacted through the clearing corporation. Now, 60% of options tend to be closed before the expiration date is actually reached, which means someone bought the option, later sold the option, never once taking possession of the shares. They just traded out of it. And 30% of the options expire worthless. Right? That's recent stats from like CBOE or somewhere like that. And now the thing is that if I then turn around and eliminate the 60% in the middle, and I simply say, well, of the options that reach expiration, only if you add the 10% against the 30% that expire worthless, then I can manipulate the stat and say at expiration, only 25% of options expire with intrinsic value, and 75% of them are worthless. That proves to me options are risky.
Yeah.
Right? That's nonsense. Like what the point is that everyone that hears these stats, it's just nonsense. What you have to realize is that it's much more dynamic. And you can't just make silly assumptions about data points like this. So let's talk about some further trade.
They're just looking at it like a stock, and they're thinking, okay, 90% of it would be like saying 90% of your stock picks go down instead of up.
Right.
And it's to your point, it's not the way to look at it, right?
Exactly. And so to me, it's so fascinating to watch people learn about options and their eyes open. And so from excitement. And so what I want to do is I want to share some of the trades that we're gonna be together when we get to that trading course down the road. We're actually going to be showing people live trades and how this all works. But I want to tease everyone with some examples, because today we're in the midst of a pretty epic crash, right?
I'd say,
And my condolences to people that are being caught on the wrong side of it. The point is that just here's a chart of the S&P 500, and just it's stunning the magnitude of this crash. Now, many of your listeners that also listen to Macrovoices heard me talk about the idea that we were doing calendared straddle as a hedging strategy. And one component of that is the ownership of the put options. And while we traded it as a speculative way of capturing what we thought was going to be a market crash, and we were right, but what I want to offer all of your listeners is a simple idea. If you were rolling that straddle that we were putting in there, and you had an investment portfolio of your favorite stocks, and at the same time, you had the straddle open as a way of having tail risk insurance on an outlier volatile move, very Chris Cole-like. And I ask, when you look at this 340 strike SPY put that we originally opened.
Can you go over a straddle really quick?
Absolutely.
Patrick,
it's just the buying of a call and a put
also
together.
Tail risk. I think most people understand what tail risk is, but if you want to define that,
it's an outlier move. And so what you want to think is a move to one standard deviation higher or lower should encompass 68% of the probable outcomes up to a certain point in the future. And obviously, then there's a move to the second standard deviation, third standard deviation, and it goes. And so tail risk is those moves when the markets go to the 3, 4, 5, 6 sigma, right? They're these big moves that are just, the market was not pricing in at all the fact that the market could do such an extraordinary move.
Like so that's black swan type of event.
Black swan. And so when you're buying tail risk insurance, what you're doing is you're saying, if there was a black swan, I want to be able to have either profited or I have built something that protects my portfolio.
Yeah.
Right. And so originally, what you can observe here is that this SPY, the S&P 500 May 340 put, we originally opened at $9.74. That option today is now worth $88. With
so you bought 10 of these.
In this example, there's 10 of them in this simulated account that we, because a big picture trading, I put on the trades live with my members, and so we always do it in the simulated account, and so this is the one we're tracking. But the point I want to say is not about, look, yes, if you were just short, you made a pile of money, but let me ask you, if you had a portfolio of let's say $250,000 of stock, and you had this position in conjuncture with that, could this $78,000 of profit help offset the losses that you're incurring on the rest of your portfolio that is getting clobbered?
Right, exactly. Could you do this in a 401k?
Yes, you can. And so, that's the amazing part. And so what is really cool about that is that's where if you go back and listen to that Chris Cole interview, he was talking about that 100-year portfolio, and a part of that is being long volatility. And the straddle that I'm demonstrating here that I was putting is one of the strategies he uses to actually go long volatility. The other one is ratio spreads and these other types of things. But the point is it's meant to put portfolio insurance at minimum. Obviously, speculators can bet on a market crash and profit from it like we did. But at minimum, you can be using it to protect your portfolio, right?
Mm-hmm. Hey, Patrick, can I just interject something really quick?
Yeah.
What I keep going back to is I know so many of my viewers are buying gold, but they want to buy the miners as well, the silver miners and the gold miners. And there's all these questions. Why are they going down? Why are they going down? I've explained it a couple times with the liquidity issues in the repo market and the
Yeah.
margin calls. But I just think this is just an incredible way that if you wanted to go long, because you know in 5 years those miners are going to be worth a lot more than they are today. What a great way to do it, to start building that long position, but
Yeah.
hedging your
So,
downside with
so
these options. Yeah.
if I may offer your listeners just a tidbit of from experience, gold and gold miners as a derivative, gold miners as a derivative of gold, right? Because if gold's ripping higher, inevitably the gold miners' profits soar and the stocks are worth much more. They're going to inevitably trail behind and profit from and even on a leveraged basis on the upside of gold move. But during a liquidity crisis,
Right.
and what we're witnessing right now is a liquidity crisis,
Mhm.
everything is sold. The correlation of all assets becomes one, and everything dumps. And there is no safe haven beyond cash.
Mhm.
And the point, though, that I want to just illustrate is that with something like gold, the real hedge comes after the liquidity event, which is that central banks, the governments, to restart up the economy post coronavirus,
Right.
are going to do a massive fiscal spend. And in order to fund the fiscal spend, their central banks are going to run the printing presses. Maybe we'll even see that MMT stuff out there, or whatever, helicopter money. It doesn't matter. Bottom line is that they're going to have some way of funding this massive fiscal spend to get everything started. That dilution, gold is the hedge for that. And so if you go through when they were running QE during 2009, 2010, 2011, that was when gold had its epic run. And
Yeah.
so those that are hoping that gold will actually be going up during this crash, it may not work out that way.
You got to look at 2008, because 2008 gold went
yeah,
up a little bit on fear, but then it would go down with collateral and liquidity issues. But as soon
yeah.
as
So
they got
here,
that,
let me put it on a weekly chart, and we
boom,
can take a look at this,
it's
right?
off to the races. Yeah.
And so if you go back here, what you can observe is that gold during it peaked out in the middle of 2000, or in the first quarter of 2008,
Well,
and
that
it
was
did.
Bear Stearns.
Yeah, it did drop 30%
Yeah, because
before.
that's the repo market, and then down
Yeah,
at the bottom is Lehman. And when Lehman took off, or
yeah,
I'd have to get it right in here. Somewhere
yeah.
there's Lehman, it goes back up. Then the
And then
collateral
it rips
issues.
173%.
Yeah,
Right? The
exactly.
point
Yeah,
is, I love gold. I'm not going to tell people to sell it, but if your expectation is that it's going to be going up during a crash, you didn't have a look at history.
yeah.
There isn't a lot of
But
precedent for
that's
that.
where options come in, because you can keep
Absolutely.
that core position but trade around it, and
Exactly.
still, yeah,
So,
exactly.
so let's take a look at this, George. So what I have here, in this portfolio, I want to isolate just the silver positions, just so that the eyeballs of all your listeners aren't going at a million different things. And so what I want to do is start off with this, okay?
Yeah.
Let's just look at the fact that here I have an SLV position, right? So this is just 6,500 shares
Hmm.
of the SLV, the silver ETF, that was originally purchased at $13.33.
Okay.
Right, up $8,000 in profits right now, an $86,000 position. We are owning the shares here, right? Now, what I did was a strategy of combining. It's called a collar. We'll talk about this in the program and how to put it on. But this is a collar, and what we do is we start off by buying insurance. And what I did about a month ago is I bought a June 30th $16 put, insurance.
Yeah.
Now, 65 puts covers 6,500 shares. So I secured a contract, an insurance policy that gave me, but over the next 6 months, a guaranteed exit at 16, which basically means if silver goes anywhere below 16, all that risk is removed.
Yeah. And guys, if you're not fully following this, make sure that you watch the first 2 episodes
Right.
that Patrick and I did in this series, and I'll put a link in the description below, and that'll make it'll put all the pieces of the puzzle together for you, so you really get what Patrick's talking about right here.
So George, how much did I pay here per share?
45 cents.
45 cents. And so at 6,500 shares worth of insurance at 45 cents means I paid $2,935 for this insurance. A lot of people like cringe. Oh, like that's a lot of money, right? Like for, it's like buying car insurance. No one likes to do it until you need it, right? And at the same time though, what I did was I sold a covered call for income to help with that. And so notice here, what I did was I'm short, negative. Remember, there's a buyer for every seller. So I'm the seller of the call, not the buyer. For that, notice how much did I pay, collect income per share here?
Oh, that 36 cents?
36 cents, or roughly $2,400. What I actually did was I went up and I sold a $19 call saying, I have all the upside of SLV as it up to 19. And for that, but above 19, I'm giving someone else the right to have the upside. For that, I received $2,400 income, which I helped to finance the cost of my $2,900 insurance policy. So it only cost me $500 out of pocket.
Yeah, yeah.
Notice now that on the insurance policies combined, I'm up $10,000 more than I'm actually up on the SLV shares, because SLV has been crashing ever since. And I have removed actually much of the risk of owning it. A lot of your listeners are asking, well, why bother doing this? Why not just sell your SLV shares? I want to own my SLV shares for the long term. I was just worried on the short term they might pull back. So what I did is I tactically hedge wrap them, so out of almost no cost. And now as silver's pulling back, I'm not losing any sleep. In fact, George, what do you think I'm doing? I'm actually cheering silver to crash, because if silver right now goes back to 13, I'm going to sell it all at 16 and buy it all back at 13, and it costs me nothing for the hedge.
Yeah.
Right? When was the last time you owned this much silver and were cheering for it to go down?
Yeah, it's really such a, if you can get your head around it and practice a little bit, and then just do some basic things. I don't think you don't have to turn this into rocket science.
Exactly.
Do some basic things to protect your portfolio, whether it's gold miners or maybe your 401k. It's a no-brainer.
It's a no-brainer. And so what I wanted to now also talk about, remember, the misconception is that options were risky, right? Well, I think stocks are risky. And I think people are starting to recognize that in the last few weeks. Wouldn't you agree?
Yeah.
So what I have here, I actually went out and we tried to buy a series of stocks to try to catch a market bottom. And we were spectacularly early. So a couple weeks ago, so what we always say in the trading world, we're never wrong. We're always just early.
Yeah, right.
And so I want to start off with this first one. Okay, so Phillips 66 was trading at $75 a share. Let me put up a chart on this. Okay, this is because this is important to put it in context. The other week before the whole OPEC thing, Phillips 66 was basically crashing from $122. By the way, who owns Phillips 66? Warren Buffett. This is a blue chip stock.
What is Phil? I just know the gas
It's an oil refiner, right?
Oh, it's an oil. Okay, got it.
And so it refines oil into gas, and it's a blue chip. It's owned by Warren Buffett, right? The thing's ripping from 120 down to like $175. And I said, enough is enough. This is getting crazy cheap. And I bet that this thing is going to bounce and we'll be back to like 85 and 90 in no time. So what do? I turn around and buy the stock at $75. In the trading world, we call this catching a falling knife.
Yeah, right.
Right? Like it's in a downtrend and I say, no, that's cheap enough. I'm going to stick my neck out and buy some, right?
Do they pay a dividend?
Yeah, of course they do.
What is it?
It's a 6.5% dividend, $3.60 a year.
Okay.
Right?
All right.
That's a pretty big dividend, right?
Yeah.
And so now this stock was $75. I say I'm going to buy it, but I'm also going to buy an insurance policy for the next 2 weeks that says if I'm early, I can just get out of break even.
Right.
Right? Now, what did the stock do in the last 2 weeks? Obviously, we had the big thing with Russia and Saudi Arabia and hammer oil, but watch the price. It's from $70 down to $45. I thought 75 was cheap, and they halved it from 75.
Man, just
Now,
gap down, not even just
down $10 alone today.
wow.
Now, I have a March 20th $75 put. Notice that I'm losing $9,000 on my original $22,000 purchase of a blue chip stock.
Yeah.
But how much am I making on my insurance? So let me ask you something. Was using options risky, or was it just buying stock without protection risky?
Yeah. And how much did you pay for the
$2.75.
Oh, right.
So
Okay.
would you rather have lost $2.75 or the $30 that you're down right now?
Yeah. Yeah.
Now, here's the exciting part. I had $22,000. We talked about this when we talked about the averaging down with the GDX example on the first video we did. I can right now sell all of my positions get the $22,000 back. You know what I can do? Now at 44 bucks, I can buy it back at 45. And how many shares can I buy now? I could buy 400 or 500 shares. And I never lost the money on the way down. It's like having a mulligan in golf. What I did was I basically went and swung. It didn't work. Guess what? Look at this. I'm going to right click and I'm just going to click exercise. See this little thing right here? And I just hit exercise. It's going to blow this position out at 75 bucks overnight. Somebody who on the other side is going to get stuck with it. And I'm back in cash and I can turn around and buy the shares back.
Yeah.
Right? And so notice I did the same thing. Kinross Gold. We stuck our neck out at $5.40, thinking it was a great place to buy it. We turned around and bought a March $25.50 put. Now, Kinross just crashed to $4. Guess what? I'm going to blow it all out at 5.5 and then buy it all back at 4. Look at this. I'm down $3,800 on the position, but I'm up $3,200 on my hedge. In other words, I'm only down $500. I was wrong. I didn't make money. I lost money, but I was able to manage the risk. You know how many people now are stuck in their stocks and they are now have to wait for 100%. Like, let's say you right now, let's just say you bought at the market top Bank of America, right? And you bought it up here.
401k.
Yeah, you bought it, but let's say you bought it at 35 bucks, 36 bucks. Now it's at 20. Recognize you pretty much need Bank of America to increase by 100% for you just to get back to break even.
Yeah, that's what most people don't realize. They don't understand that math. They think that if it goes down by 50%,
30%,
they get
40%.
a 50% gain, then they're break even. They don't understand how that works.
And so what you want to think is that what these hedges now have done, they allow me to reposition on these things and never having lost the majority of the money. And more importantly, by exercising all of these puts, it puts me back into cash. And I have all of this cash to go shopping, buying these stocks that are being given away at these super discounted prices, while most investors that are fully invested don't even want to load up their account and look at it. Because they know the number is going to be so ugly that they don't want to even look.
Yeah. I mean, correct me if I'm wrong, but from just the outside looking in, it seems like this is just a great way to play volatile markets. The only way you could I'm not going to say lose money, but the only way that you could not do extremely well is if the market just stays flat. If you got these big swings, then you're gonna really be able to cash in if you know what you're doing.
So here's the key, George. The key is what we talked about in the last two videos, which is we're seeking asymmetry. How can
Yeah.
I always lose small and win big? And how can I manage my positions? What I love about options is it gives me tactical ability to manage these positions in and out, around, and do all of these different things. Look at the way I hedge wrap silver. Look at if silver goes to 13, I'm just going to reposition and stay long silver. But now I've just improved my price by $3, right? Like the thing is that you can do all of these things and still own your favorite stocks. But most people don't even know they can do this because they buy into all the myths and misconceptions about options, and they're risky and it's only for professionals and you're crazy to learn about them. And then they're missing out on all of these amazing things they could be doing because they don't take the time to educate themselves. And I'm leaving it at that.
Well, that was amazing, Patrick. I just, again, learned a lot, and I cannot wait. So when we decide on what you're actually going to do after the next class, the next episode is going to be our last, but after that, you're going to most likely do a course where the viewers can log in. I'll be there, and you're going to go through in the real. Yeah,
we are going to go through. And what important, you know, that account that I was just showing with the live trades.
Yeah.
The whole point is we're going to put live trades in. What we're going to do is we're going to not just show all this theory, but we're going to put theory into practice. That's where we're going to connect the dots.
Clicking each button and understanding exactly
right, because that's how people learn. People don't like watching PowerPoint slides. They want to see you put it in with some real money so that they can wrap their head around this idea, or at least real prices. And because we'll use a simulated account, but we're going to really get in there and explain all of this and demonstrate it by putting on these trades. And that's how you learn, and that's where you connect those dots.
I got it. Well, this is going to air Thursday night. The next episode, the last episode, will air probably next Thursday. We'll keep on that pace. And then the next episode will disclose exactly what to do if you want to be a part of that live session with Patrick. And I guess I'm going to be there. Hopefully I'll be a spectator. I don't know if I've got enough confidence to even if it's a simulated.
Well, listen,
account,
you're going to be you're going to ask all of those questions that your listeners want answered, because you're at that level with them where you know that if you're asking the question, there's a whole bunch of your listeners that are asking the same question.
Yeah, exactly. It's just the questions that I want to ask, and this is really exciting. So thanks again for your time, Patrick.
No problem.
I can't wait to see you next week.
Thanks, everyone. And thanks, George. And we'll look forward to giving next week. By the way, George, what we're going to do is I'm going to go into greater detail about that silver trade we did. So you know how we did that hedge wrap around silver? We're going to dissect that. We're going to go in there and talk about how to build one of these collars. So you don't have to get into the paid course for that one. I'm going to teach that for all of your listeners next week.
Yeah, and just for everyone watching this, there's going to be a fee just to compensate Patrick for his time, but we're going to keep it very, very low, so it should be affordable for everyone. Patrick and I will discuss that offline, excuse me, and then just go ahead and present that next week when we do the next video.
Thanks a lot, everyone.